The VR community is somewhat of a new world, and the investment community is looking at so many different sectors. So where's that going to go? How's that going to translate? What does the future look like? And we're going to talk to the experts who are making a lot of these decisions every day, and we're going to learn what's going on. So we're going to start to have our panelists introduce each other and talk about where they fit in the financial ecosystem. We're going to start all the way at the end.
Hello, my name is Corey Wagner, and I work at Silicon Valley Bank. And so we are the only bank in the world, as far as I know, that is exclusively focused on the tech and innovation economy. And so my team in Los Angeles mostly banks and debt finances, Series A, Series B tech companies. So that first round of institutional funding, we come in and layer in debt on top of the backs of equity. So it actually would have been more fitting if I went after these guys, because I will always follow the equity investment from these gentlemen. So thanks for having us.
Hello. I'm Michael Yang. I'm a managing director at COMCAST Ventures based up in the Bay Area. And we are the venture fund affiliated with Comcast Corporation. We're a 17-year-old venture fund. And we invest in a variety of different stages, and I lead our VR and AR investments. In the last year and a half, we have invested in 7 companies in the space. A couple of them were here at the event today, Felix and Paul Studios, Baobab Studios, but some of the other ones include NextVR, AltSpace VR, Kite and Lightning, and Meta on the augmented reality side.
Fantastic.
Good afternoon. I'm Steven Saltzman, Managing Director for VR and AR Investments at Intel Capital, which is Intel's venture arm. We actually go back to 1991 and have invested in over 1,400 companies, over $12 billion in 57 countries. And this is officially a newer effort for us, about 3 months that I've been in this role, although a number of our investments over the last several years have branched into VR. So there's actually a pretty good portfolio of VR companies, more on the enabling technology side. And now, in addition to that, we're working on developer tools, apps and content, both commercial and consumer apps and content.
Great. Hi, I'm Marco DEMIROZ. I guess we're the baby in the group. We're a 9-month-old fund, the Venture Reality Fund, or we're also known as the VR Fund. And started in January with my partner, Tipitat. And our only focus is VR, AR companies, seed and Series A stage, targeting $50 million fund. We've been fortunate to raise most of it already, and also been very active investing and co-investing with Michael and other friends. We now have 14 companies in the portfolio, and out of 14, 5 are in the content game space, and 9 are sort of fundamental technologies and platforms.
Okay, fantastic. And I'm Marcus PETERZELL at KETCHUM, and the way we play in the space, if a company was to get an investment, what do they do then? Well, the first thing, to create noise, obviously the first thing they do is come to this conference. Had to say that. And the second thing is not to issue a press release. So there's a PR agency saying press releases are dead. It's just a waste of money. You've got to create noise and create activity in an innovative way, because you want to get noticed, you want to be in the trades, you want to be where you need to be for your verticals. So that's where KETCHUM plays in the ecosystem, making sure these companies get noticed, they get PR, and they can elevate themselves above the competition. So I've got a question for the team, and we're going to start in reverse order and kind of get 60-second answers here. So the first question is, overall, do you think you're in an aggressive mode in relation to you've got to go fast, because if you don't fund some company, another venture will? Go fast, go aggressive. Or are we at the stage now of let's sit back, let's wait, let's see if these companies really turn profit? So are we in aggressive mode or sit back and wait mode? Marco, we'll start with you.
I think we're sort of the Goldilocks model. We're in the middle. And, we don't really have to make investments just to, sort of fill a portfolio. And also, and just a full disclaimer, and both Tip10 and I were completely bullish on the sector and sector growth and opportunities. So we're in active investment mode so far. We've been fortunate to find great investments like the Visionaries and Eonites and Limitless and Spaces and Immersive and others. But, for us, there isn't really an urgency to make investment, but there is really a desire to make very high quality, transformative investments. So, so we don't really feel any time pressure in terms of our investment style, given the market dynamics. We want to make sure that our companies are funded for a minimum 18 to 24 months, because we don't know the adoption rates. So, for us is, sort of survival or longevity is really important. All of our deals are syndicated. From our perspective, the market is extremely collaborative. We work with Michael, we work with other, co-investors, and our desire is really help the company to sort of go through the adoption curve, have, great sort of cash runway, so that they can execute pristinely without having to rely on, consecutive fundraising every 6 to 9 months.
All right, great. Are you going to have the Goldilocks view or no?
Not really. It varies a lot by subsector. In certain areas, some of the enabling technologies, for example, these are multi-use, so they may be applicable to AR and VR, they may be applicable to Internet of Things, to mobile computing, smartphones, whatever, and that can lead to different dynamics and different pressure on things like the applications and content, and even some of the developer tools. From our perspective, a lot of things have gotten a little bit frothy, and we've walked away from some things we thought were very interesting because, they were looking at projections, realistic projections of maybe doing 2 million next year and having valuations of 50 and 60 million, and it's like, okay, well, great, bye-bye. If you're still around in 2 years, we'll come back when your valuation is appropriate. But it's very much by subsector. There's not really a VR market.
Yeah, I agree with both gentlemen, actually, and I think jumping off of what Stephen just said, VR is not monolithic or AR is not monolithic. We came to becoming interested in investing into this segment about 1.5 years ago because we were searching for the next major technology computing platforms, right? And if we've moved beyond mobile, ostensibly, what's next? It could be VR, it could be autonomous driving in vehicles, it could be Internet of Things, but we didn't have much exposure in VR, so we kind of started looking, and we were open to hardware, enabling systems, software, applications, content, you name it. As we got into it, we started to see some segments actually really take off, and I would say take off from a funding perspective, not so much even from a commercial traction perspective, but I'd say content, which is what we're all about here, on this particular venue, that has taken off quite dramatically within the last 12 months. And I also think that that window is going to be shutting rather quickly sometime next year. So, just like when the iPhone came out, and if you went to WWDC, Steve Jobs needed to showcase a few application developers up on screen. Oculus has done that, HTC has done that, Sony's doing that. They're picking their marquee games and kind of content players. And we've primarily been focused on investing into those genre leaders or those category leaders. And then, like Marco said, making sure they're capitalized to wait out adoption, because adoption's not even going to be 1 year, 2 year, it could be 3 years, could be 5 years. So either you have a revenue model, which is going to be hard to come by, or you have plenty of venture capital money to allow you to manage until that time really comes. So that's how we've been thinking about it.
All right, great.
Yeah, so that's actually a perfect segue. So since our model's a little bit unique, I think the first thing we look for is that initial investor validation with any company. And so, as Michael comes into a company, we look at that and we speak to him and understand what's so appealing. I think that's when we start to map out, ultimately we want to look and understand how these companies, how a VR company is going to continue to raise capital. And the reality is today, it's going to be strategic or it's going to be Chinese corporate capital. It's one of those two paths is the most likely entryway. If you look at a professional money investor, so if you look at a Sequoia or an NEA that has a dedicated fund, they have a very linear financing path and strategy for financing a software company. You can Google KPIs with which you could finance a company and what your valuation could be, and you'd really understand it. VR is very murky. I mean, we're still identifying adoption, we're identifying which spaces are most unique. if we look at a couple billion that was deployed, a little bit misleading given Magic Leap, but if we look at, a couple billion that's been deployed year to date in VR investments, the bulk of it hasn't been in content yet. It's more on the hardware side and tools and services enabling the creation. So I think for us, it really depends upon, we get very excited and frothy and leaning forward when we have the right investors that are validating the company. And it's in a space that appears to have that traction and further financing capability down the road.
Got it. All right, so I've got a question for the group, and for people in the audience who may not know the process, my analogy, I come from the music business, so the only thing I know is if you're a rock band, you want to get a record deal, you record 3 songs, you send in your photo, your social media numbers, and your tour schedule to a label and go, here's my stuff, do you want to sign me? That's how it works in the music business. If you're a VR and you just invented a new lens and it's a third of the size of the gear and you've raised some money and you want to get to you guys, what do you want from them? When they send you information, what are you looking for? What is their kit? And B, in terms of flow, are you getting these solicitations every week? You're getting 5, 10, 50, like how much flow is there coming your way? And what do you expect people to send you?
Yes.
I think the deal flow is really least of our concerns. We get significant inbound interest from a number of companies. Frankly, it's coming from all across the globe. Europe, China, Japan, Australia, really pretty much pretty global. Our criteria tends to be sort of, we're trying to align our investment strategy with the market dynamics. Being an early stage fund, seed, Series A fund, we don't want to get into R&D projects that they may not have come to fruition for a long time. So all of our companies are expected to have a commercial product release within 9 months after the investment. And so that's one criteria. Obviously, I'm gonna skip the standard criteria. You have to have an awesome team, some relevant track record.
Don't tell us.
Okay, well, you have to have a great team, right? You have to have a kick-ass team. The team is really what you bet on, because we're not able to predict the market dynamics. What we can really do is invest behind great people with great vision and have them navigate the market dynamics. But our expectations at a high level is that you have sort of complementary team and team dynamics to really address the core market opportunity. Obviously, you get additional funding from us and this group and Corey to complement that, sort of build a platform. But make sure that you don't really get into, especially early stage investment is already pretty sort of treacherous in terms of your risk-reward profile. In a brand new market like this, it's really compounded, right? So team is really important. Go-to-market strategy is really important. Capital use is really important because we really want you to have longevity. So don't come and say, we're going to create this content in the next 3 years, come back to market at early 2018. That's really doesn't make sense for us. We really want you to be out there in 3 to 6 months, maybe smaller, focus, and learn a lot about the user feedback. This is a new medium. Coming from mobile gaming background, we saw that console, people couldn't transition from console to mobile gaming, different form factor and different experience. We have similar apprehensions about people coming from mobile and console coming into a spherical environment. It's very different. So we look at all these factors and we look at the market, timing, and make sure that, we believe in the big vision and believe in the team's capacity to execute that.
Have you ever done a deal where you didn't meet the team in person?
No. And not only that, we always have to see something on the content side. We want to be amazed with what they have.
Okay, fair.
So our perspective is a little different because we are part of Intel. First of all, on the inbound side, we've got 100,000 employees in 160 countries, this eyes and ears. So if there's something relevant, as long as we're communicating outward, there's a good chance we're going to at least be exposed to it. Not always, and so we still want any lead you have, please send them our way. The fact that we're part of Intel, though, leads us to do a little different triage than a typical venture capitalist. There are people who need help taking what was maybe something that was an enabling technology in the military space, because that's where VR has been for the last 2 decades, where they ship hundreds of units a month, and they need Intel's help to figure out how to ship millions of units per month at consumer price points. So in some cases, we will matchmake them with our product groups and we actually have consulting groups within our technology manufacturing group, and we'll say, okay, here's a 2-year program to take you from what you're doing to what we want the market to be, and as part of that, we'll be funding that program, and we'll take some equity as part of that with options to then extend more. In some cases, there's people that have really interesting content projects. It's like, okay, that's not really a business, but that could be a good showcase of this new capability. And in some cases, we'll take them to the product groups, and they'll actually commission a piece to showcase something, very special. We are actively working now on a new model to fund content, because in general, content, like most games or movies, doesn't really fit a venture capital model. So nothing we can announce yet, but we are working as a way to look at some alternate ways to fund that.
Okay, great.
I'm pretty confident Marco and Tipitat see the most VR, AR deals of anyone on the planet, and that's why we all work collaboratively so we can hear what they particularly like and what's the best from what they're screening. But even us, we'll see a couple hundred VR, AR specific things like this year alone. So, and that'll probably only increase going forward. For us, back to the team side, we're not interested in backing teams that have not been playing with VR. If they're new to it, that's not us. So we look for the pioneers who've been grinding on early DK1 units, so they've been, on a long journey, suffering through bad hardware, bad connectivity, bad, everything, and have still persevered and want to do it. So that's a key one for us. I think the other thing then we start looking at is, what is their go-to-market? Who do they have to collaborate with? And, what are their major dependencies? We will often call the major HMD platforms and ask them if they know this team, and if they're on Google or Oculus or Samsung or HTC's and Sony's kind of radar, then that's a good sign, because you really need to kind of be working in that slipstream and not being crumpled by them in order to kind of sustain yourself. And then, for content creators in particular, they got to show us stuff, like you said. So that means they've been doing it on their own dime before they even show up at our doorstep.
Great.
Yeah, and I'll come about this a little bit of a different way. Since we talk with obviously hundreds and hundreds of entrepreneurs in any given year, most, particularly the early companies, the seed, pre-seed, those raised a couple $100,000 from friends and family, they're constantly looking for us to leverage our relationships with the venture capital community and make those introductions. It's not something we typically take lightly, and so to your question about how do we get to these guys, what I usually engage with companies and help them to get to VCs to explain their company is a couple ways, and guys jump in and correct me if this is wrong. One, through a existing portfolio company seems to be the most logical, incredible path to get to an investing partner. If you can meet the bar of a portfolio company which has been funded by a VC, and actually have them leverage that relationship to make that introduction, that's probably the most credible. Otherwise, you're very much leveraging mine or my colleagues' individual relationships with these guys. And in order for me to intro outside of some events that we'll curate and throw with the venture capital community, for that one-on-one introduction, it's really very much about team and an assessment of, fundability in the moment. So we might look at it and evaluate a company and say, okay, you've been working on this for 2 months, you have limited access to the space, you're kind of feeling out your revenue model. It's probably a little early for me to leverage that relationship and introduce you to one of these guys. Conversely, if you've been at it 5, 10, 15 years and have a really strong point of view, and you know exactly your use of capital in the market you're going after, I will gladly make the introduction. And so that's typically how we approach it.
Got it. So it's a little early to talk about success stories in this environment, but I'll ask anyway. Does anyone have oh my God, I found this thing, I was the first in, and now look what's going on? Does anyone have a great success story? Because we all love to hear those.
I mean, we really love every one of them.
That's scary.
So our companies have been awesome. They're all off to a pretty good start, but I wouldn't really single out one of them, because I feel like we're fortunate to be working with these great entrepreneurs. They all have incredible vision and great teams and sort of great perspective of how they're going to really impact the whole ecosystem. So our expectations are pretty high, but again, I think our love is equally distributed across the whole portfolio.
You can't pick one child over another,
No,
is what
we
you're
won't pick
saying.
anyone.
Well, also recognize that the state of the market this year, the most optimistic estimates are around 400,000 units out in the universe, and half of those at least.
Including Sony?
Not including Sony, I'm sorry.
Okay.
And I think they're hoping to get a couple 100,000 more. So generously say 600,000 worldwide, and half of those are easily developer units. So, you know, the market doesn't exist yet. I mean, a big part of what we're trying to do is catalyze the market. Even where there have been some exits that are maybe profitable for the early investors, it's based more on expectations of the future of the market and maybe really strong IP positions. It's not based on, here's somebody who's built a $300 million a year profitable revenue stream, and therefore they're then having a big exit. So I think we'll be kicking our heels, you know, in a few years, hopefully, as the market is truly mainstream. And again, from our perspective, we expect it to be almost 50-50 between consumer applications and commercial. And when you look at the monetization side, I mean, there's deals we're working on now where people are actually just leasing their solution for $10,000 a month per workstation. So on the commercial side, there's some really interesting business models and opportunity for very quick company growth.
But, you know, if someone's in the audience and they're listening to this and like, God, I'm not there yet. I've got a great product, a great idea, I've got a great team, but no, I'm not meeting this criteria yet. But I do need funding. Is it just friends and family? Is there any other way to go when you're really early on?
Well, one test of an entrepreneur is how bloody scrappy are you? You know, if you don't come from a wealthy family, and there are a lot of trust fund babies playing in VR right now, by the way. But if you know you don't personally have the cash, and your immediate friends and family either doesn't like you or they don't have the cash, you know, look at creative ways to do it. Is there a strategic customer that may do something on a branded basis that you can then leverage that foundation for the future product of what you really wanted to do? A lot of companies can get started with customer financing. You know, prepay for this and kind of get the ball rolling that way. Also, if you've got gaps in your management team, it's more important that the core team you have are actually, you know, grade A talent. We'd much rather see, hey, I've only got 3 people on the team, they're all bloody rock stars, and here's the other 4 gaps we have. And it's like, okay, well, with the right funding and everything else, we can help you recruit the right talent, rather than somebody say, I had 3 rock stars, and then I needed to fill 4 slots, so we found 4 mediocre people to fill them, because they're just going to be weigh you down.
I'm just curious if anyone here plays the matchmaking game, and you look at 2 companies, they've got something but not there, something that, but wait a minute, actually they're in the same space. If we put them together, then maybe there's something there. Does that ever happen?
Harder with companies, easier with people. So if you have 2 founders that haven't been well capitalized, or maybe they're still at that very formative stage, it's easier to say, hey, you guys kind of working on the same problem, kind of going about it differently, but why don't you collaborate? There's no point both of you guys raising money than trying to beat each other's brains out in the marketplace. I think once you are formed and you're venture backed, each company has its own shareholders, and they're going to be particular about things. It's a lot harder to kind of pull those together.
The reality is probably more commercial agreements might make a lot more sense for those introductions, right? So you have 2 companies that might not directly compete against one another in the same space, and so that introduction might be accretive to each of them, at least from a revenue or product perspective.
I'm skeptical of matchmaking because it's really hard to replicate founders' passion. Right, and you know, I'm also skeptical of VCs starting ideas and then hiring people to execute them. Mostly fail. But if you look at all the successful companies, really, one of the common factors is really predominant factor is founder's passion, founding team or the founder herself. And so for us, matchmaking would be the sort of least desirable outcome versus finding the right team that they're really dedicated to change the world, and we want to be part of that experience. That's really what's interesting. Going back to your earlier comment, the angel market is evolving right now for VR, AR. And out of 14 companies, we have 6 of them through Series A, sort of formal rounds with investors and so forth. 9 of them are also a combination of institutional and angel investors. So especially Silicon Valley, and I think LA, maybe in Seattle, and then sort of the Boston, the angel market is picking up. So you may not be ready to meet COMCAST criteria, but we may be ready to work with you to get there. And that's sort of part of our role in the ecosystem.
Got it. And what happens, you've got a company, you've got the 2 founders, and you've made the investment, they're working, and one day, divorces do happen, and there's a complete split, and it's a disaster, and they both walk away, and you've got an investment. Do you kind of take over their assets, but then you're like stuck running a company, which is not what happens?
Can we go to the next question? Look, that's really a disaster scenario. I mean, in my opinion, VCs should not get into operational aspects of running company unless there's an issue. Typically what happens is, he and I start a company, and after 10 months we may have diverging opinions, or maybe our roles are not gratifying for what we thought we would have. So that one is relatively easier to figure out, and you can say, Stephen, you run the company and Marco will be the CTO. Maybe not, but, so that kind of, thing you do in early stage, just because you have a team, they have sort of formative ideas, but when you sort of start building, say, 4 of us, and after 9 months, things might change. But if the founders are hating each other, they both leave, and so we turn over to Silicon Valley Bank, and hopefully they'll figure something out.
You never know when these things happen. Go ahead, Michael.
No, I was just going to say, founders squabble all the time, so it's to be expected. And some places, I don't know if it's Y Combinator or others, actually suggest, no solo founders and more than even 2 founders. So some places like 3 founders or something else like that. We don't have any rules like that, but we expect not all founders are going to have the stamina post-funding. And that's also why you bring in other functional management and executive hires into the team.
I would just add, the co-founders is exceedingly handy. I've had, in 2 instances this year, very well-capitalized companies where the sole founder and CEO, for whatever reason, bad or good, exited the company. And without that next step of leadership, there is a gap, and it is really disruptive to the business. And I call guys like this frantically wanting to know what's going on.
And I guess I would always also ask, would you ever recommend a company you fund to take some of that budget and give it to a PR agency like ours? But we're out of time, so we can't answer that. I want to give everyone, thank you so much, give everyone a big round of applause for our panel today. Thank you, gentlemen, for joining us.